My sadness is immeasurable and I am crushed. Hey everybody, Walrus here from Walrus Street, bringing you your news and earnings for the week of July 19th, 2021. Just a reminder, I am not a financial professional. All information in this video is for entertainment purposes only. You know what's really not fun? Checking your trading app every morning when you wake up and seeing that you lost about 2% of your trading portfolio every single day last week. That's cool. Seriously though, last week was absolutely miserable for most growth stocks, which is what my trading portfolio is pretty heavily invested in too. My retirement portfolio, made up of mostly ETFs, didn't really suffer that much last week, but my trading portfolio got absolutely Tyrannosaurus wrecked. Here's to hoping that this week is going to be a little bit better. Last week we had a combination of a couple of things hitting it. We had Janet Yellen yelling about inflation. We had the CPI report come out and show more inflation, and we had the banks reporting killer earnings, and typically when banks are doing good, everything else is doing bad. Before we get into the news today, I noticed that today when I was setting up my episode, it had a little bit of a common theme woven throughout, and I don't know if it's subconsciously I did this when I was making it, but the theme for today's episode is going to be mature companies that seem to be a little bit overlooked right now and definitely have some opportunities. Keep that in mind while you're watching the video today. I mean, it doesn't really matter much, but you are going to see that commonality between the stories that I'm presenting today. Let's get started. First news story, Pepsi reported their earnings last week and absolutely smashed it. PepsiCo raises forecast after earnings crush estimates fueled by returning restaurant demand. So their net sales surged 25% year over year to 19.22 billion, topping expectations of 17.96. The fact that they surged 20% year on year isn't actually super impressive when you consider last summer everybody was on lockdown. However, the fact that it was more than $1 billion over their estimates, that's impressive. Pepsi is seeing a return of demand for its drinks from restaurants and other food service customers. EPS was up $1.72 versus $1.53 expected. For Pepsi, because it's an international organization, they typically report something called organic revenue. So organic revenue strips out the impact of foreign currency, acquisitions, and divestitures, and this rose 12.8%. The company's North American beverage business reported organic revenue growth of 21%, the highest out of all of Pepsi's divisions during the quarter. This makes sense because Americans have just been absolutely itching to get out of lockdown and get back to normal, virus be damned. And you can probably understand from seeing the news that other countries around the world have better control over their citizens than America does. So the fact that PepsiCo is already reporting a higher growth, a higher return to normalcy in America is not really surprising. PepsiCo branched out into foods, and this happened a long time ago. But when a lot of people think of Pepsi, they think of just beverages, and they think of its lead competitor being Coca-Cola. But PepsiCo is actually a more fully hashed out, diversified business than Coca-Cola. PepsiCo had organic revenue growth in Frito-Lay, which has brands like Doritos and Cheetos, and Quaker Foods North America was the only division to report sinking organic revenue, but there's a reason for this. Its volume fell 21%, pushing revenue down by 14%. The same time a year ago, the segment saw organic sales surge 23% as consumers ate more breakfast at home, fueling demand for maple syrup and oatmeal. This division is still up 9% on a 2-year basis. You're going to see a lot of this. They're reporting instead of just year on year, a lot of them, to paint a better picture, are reporting a 2-year basis, just skipping over the pandemic year because it skewed statistics so heavily. Pepsi also narrowed its forecast for 2021 organic revenue growth from mid-single digits to 6%. The company tends to provide more conservative forecasts, which set it up to beat expectations in the second half of the year. So this is just from Wikipedia. This is a list of the trademarks that Pepsi owns, and a lot of the international ones I'm not too familiar with, but Aquafina I know, Aunt Jemima I know. Aunt Jemima is going to be undergoing a name change soon because of the, I guess, racist connotations of Aunt Jemima. Cap'n Crunch, Cheetos, Cracker Jack, Doritos, Frito-Lay, Gatorade, go Gators, Lay's potato chips, Life Water, Miss Vicky's jalapeno kettle chips, yes please. Mug root beer, Naked brands are under the Pepsi umbrella, Quaker Foods, Propel Water, Ruffles chips, Sobe Life Water, remember this one? That was big when I was in high school. Tropicana, Sun Chips, my favorite chips on the planet. And then they actually have joint partnerships on things like Starbucks in-store drinks like the Frappuccino, the double shot, the kind of stuff that you find in 7-Eleven, Lipton, Sabra hummus. Yum Brands. Yum Brands is a big one. This one has like KFC, Pizza Hut, Taco Bell. If you're wondering why you always see Pepsi products in those stores, it's because Pepsi does have an interest in those companies. Pepsi is a very mature company. They're killing their earnings. They're going to be beating their earnings for the next couple quarters, most likely, because they're going to go conservative on the forecasts. And Pepsi just has a great portfolio of brands. Next news story, and for a lot of people, this is the most significant one of the week. And this one actually has the possibility of changing lives outside of just investing. Schumer proposes federal legislation to decriminalize marijuana. Senate Majority Leader Chuck Schumer proposed legislation to legalize marijuana at the federal level. This isn't just state level anymore. This is federal level. This is the big one that we've been waiting for. The Cannabis Administration Opportunity Act would remove marijuana from the Controlled Substances Act and introduce regulations to tax cannabis products. America loves taxes. Most governments do. That's how they're going to get their income. But here's the big thing. It would also expunge federal records of non-violent cannabis offenders. Cannabis offenders with a federal record have a difficult time finding employment. But if their records are expunged and marijuana is legalized, then they'll be on the same standing ground as other people. This plan would also create an opportunity trust fund from new cannabis tax revenue in order to invest in programs for communities most affected by the failed war on drugs, according to the draft of the bill. So in a way, this opportunity trust fund could be used as sort of like an addition to the infrastructure bill, where the money is specifically targeted into communities that have been adversely affected by the war on drugs. And we all know how bad the US has lost the war on drugs, almost as bad as Australia lost the war against the emus. Emus are just a force of nature and you can't fight them. Emu's gonna emu and Americans gonna smoke pot. I really wanted to look at the financial impact of what criminalization of marijuana has meant to America. This is obviously a biased site. This is on Cannabis Offers, but I did find a lot of the statistics that I was looking for kind of in one place. So I just want to read a couple of these. The US makes 600,000 marijuana arrests on average each year. These arrests would go away if it's federally legalized. The US spends $3.6 billion on marijuana arrests every year. So for those 600,000 arrests, the US is paying about $3.6 billion. That is a lot of money per arrest that instead is going to be saved. And instead of the net loss on using the money for those arrests, there's going to be a net gain with the taxation. A marijuana conviction can cost the felon from $2,000 to $20,000 in defense. And marijuana arrests can result in a loss of income for the convicted felon. One study estimates the loss of a convicted felon to reach $306,000 in a lifetime worth of earnings. So all in all, this is going to put more money into the economy. From an economic perspective, marijuana legalization to me is a no-brainer, and I don't really see a valid argument otherwise. Very briefly, I know I've been talking about it a lot on this channel. Richard Branson completed the Virgin Galactic flight aiming to open up space tourism. Soaring more than 50 miles into the hot, glaringly bright skies above New Mexico, Branson at last fulfilled a dream that took decades to realize. He can call himself an astronaut. The whole flight took about an hour from takeoff to landing, and it was all televised online. I watched the entire thing, and really, I just felt like a kid. I was so excited. It really reminded me of watching shuttle launches from Cape Canaveral in the 90s. This type of space exploration is so exciting, and whether or not you want to quibble about the Kármán line or whatever, the fact that this is even happening is really opening up a new era in the economy where we're going to have space tourism, and from that, who knows, maybe we end up colonizing Mars, the moon, maybe we end up mining the asteroid belt. Now, I realize a lot of that is a long way off, but this is truly a small step forward, and really, I can't help but get excited for this. Last week, I mentioned that the share price was probably going to rise off of this news. I'm owning up to my mistake. Boy, oh boy, was I wrong. Apparently, all of the excitement about Branson going up into space was already priced in, and from there, there's nothing but disappointment for Virgin stock. To make matters worse, on Monday morning, Virgin Galactic Holdings to launch stock offering of $500 million after successful spaceflight test with founder Branson. That's right, the company is offering shares. Any excitement that was to be had with the spaceflight, and actually pre-market on Monday morning, the stock did run all the way back up to like $60 a share, but that ended up tanking, and we've lost substantially since then. I think we're down about 40%. Full disclosure, as soon as I saw the news about this offering, I sold everything around $45 a share, I believe. I gained substantially on the position, and I'll just be looking for another entry in the future with Virgin. I don't think it's done dropping at this point because there's really no immediate catalysts coming up. The stock offering killed any momentum they could have had. bad. And here's the Virgin Galactic chart. You could see throughout the week, we ended up just falling off a cliff. The highest we got again was 48.30 and then just dropping down. We're even lower at 30.11 after hours. And a lot of the bids coming in are below $30, $30 or less. So there's just not much excitement about this company right now. You know, the share price ended up tanking 40% this week. Tough going for Virgin Galactic. Next up, you guys know I gotta talk about it, inflation and the consumer price index. So the CPI report was released. Just a couple of points that I want to read to you guys because this is obviously very dry, very boring. The CPI for all urban consumers increased 0.9% in June on a seasonally adjusted basis after rising 0.6% in May. So this is a 50% increase month on month. It was the largest 1 month change since June 2008 when the index rose 1%. Over the last 12 months, the all items index has increased 5.4% before seasonal adjustment. The index for used cars and trucks continued to rise sharply, increasing 10.5% in June. This increase accounted for more than 1/3 of the all items increase. If you take out the used cars and trucks from the index, that takes out 33% of the increase in price, and then we're looking at just 0.6%. Now, I know you're thinking, oh, but how can you just take something out? The thing about the used car and truck price increase right now is it's not entirely associated with inflation. I mean, yeah, the materials for new cars are, but the thing is, this used car price increase is because of the semiconductor shortage primarily for new cars. New cars are mostly waitlisted right now, so people are turning to good used cars, which has driven up the price of them. So it's not really inflation based, it's more like a supply chain failure based. This really makes you think of the JIT principle of supply chain management, which was popularized by Toyota, I think in the 1990s, late 1990s, early 2000s. Don't quote me on the year. But JIT is just in time, and it's the whole concept of supply chain management where you don't stockpile products that you need. You don't stockpile components you need. You only order what you need as you need it, and this allows for a more smooth operation with less overhead costs. The problem was COVID just destroyed the world's supply chain, and even still we have container shortages and backups all around the globe. So the JIT method of supply chain management has really just kind of thrown a monkey wrench in everything. And, you know, ipso facto, we have increases in used car prices, and it's skewing inflation data to make it look worse than it is. Look down here at used cars and trucks. In April 2021, we were at 10%, May 2021, 7.3%, June 2021, 10.5%. The previous months leading up to that were negative 0.9, negative 0.9, negative 0.9, and 0.5. So to go from these numbers to 10, 7.3, 10.5, holy crap, that's a massive increase. And now all three of those months, the 10, the 7.3, and the 10.5, this is going to be the second quarter for a company like Shift reporting their earnings. I'm still standing by the fact that Shift is going to have monstrously blowout earnings. It's probably going to be their new record for revenue for the quarter because of these inflated prices. So this CPI report is bad, looks bad, but the used car and truck statistics are skewing everything significantly. And once again, that's a supply chain issue more than an inflation issue. Next news story, we had all of the big banks report last week. JP Morgan, Bank of America, Citigroup, Wells Fargo, Goldman Sachs. All of them crushed their earnings again. The biggest US banks reported stellar quarter two performances. Really, these were across the board great earnings, and I'm not actually going to single out a single company to look at because just objectively, they were all good. If you really want to look into it, pick one of those companies and check it out, but trust me, they were all really good. While 2021 is turning out to be a weak revenue year, continued improvement in the broader economic environment, strong credit quality, and net reserve releases are significantly boosting the profitability of top American banks. Furthermore, banks continue to return excess capital to shareholders through dividends and share buybacks. Quarterly performance for some of these banks was better than others. We have up at the top Goldman Sachs 70%. We had JP Morgan 54%. We have Bank of America at 39%, Citigroup at 9%, and Wells Fargo at negative 11.6%. This is the time where I want to start thinking about adding some extra bank exposure to my portfolio, not my trading portfolio, but my long-term portfolio. And out of the big banks in the US, the position that I'm personally going to be adding is Citigroup. Citigroup has the lowest PE ratio, the lowest PB ratio, and compared to the other banks, it has slightly underperformed over the last couple quarters, which isn't too alarming because loan rates are really low for all of them, and Citi does get a lot of its income from loans. So once interest interest rates start increasing, people start turning back to banks for their money to take out loans, the banks are making more off the interest rates for those loans, Citigroup is going to bounce back in a big way. And I'm not the only one that thinks this. Citigroup developed better than expected Q2 results. Earnings of $2.85 per share handily surpassed consensus estimates of $1.96 per share. What? Seriously? They beat it by almost $1 per share. That's incredible. That's almost a 50% beat. While end of period loans slipped 1%, deposits increased by 6%. So more people are putting their money in the bank because they don't feel good about putting it elsewhere. Loans are slipping, but once again, that's not a big deal because interest rates are low. Oppenheimer analyst Chris Katowski assigned a buy rating with a price target of 116 to Citigroup stock, 12-month upside potential of 70% from current levels, and he added Citi remains one of the cheapest banks in our universe of coverage at 0.88x tangible book value. That's the price book ratio. Overall, 8 Wall Street analysts have weighed in on Citigroup shares in the past 3 months, giving the stock 7 buys and 1 hold for a strong buy consensus. The average Citigroup price target of $89.44 implies approximately a 30.7% upside. If we look at the Citigroup stock, back from last Halloween when it was at its lowest, it dropped down to about $40.49. We ended up peaking around $80.29, and this was at the beginning of June. And since then, even after the earnings, we've fallen off, and we're sitting at about $66.92. Here you can see the PE ratio of 7.3, which out of those 5 banks is the lowest. PB ratio, here it's being reported as 0.736. There's small differences there, but it's still the lowest either way. As far as banks go right now, I think Citigroup is the best bet for an investment to return good growth. The analysts are all in agreement. The consensus is for almost a 31% upside over the next 12 months, which, if that holds true, is obviously probably going to beat the market. And we also know that the Fed will be increasing interest rates. And as the inflation numbers grow higher and higher, it seems like the date to increase the interest rates creeps closer and closer. So this time when Citibank is going to start making killer revenues off of loan interest rates is getting nearer and nearer. I really do want to start opening a position in Citibank and adding to it while we could take advantage of these lower prices. Next news story, Oatly was accused of overstating revenue and greenwashing by activist short group Spruce Point Capital. Activist short seller Spruce Point Capital Management has accused Oatly of shady accounting practices and greenwashing. Greenwashing is a really cool term that I learned today when I was reading this. Greenwashing is when you take your company and you try to extol the virtues of the ESG principles that you're putting in place, of the way that your company is so good for the environment and all of the great environmental things that you're doing. And it's really just a PR ploy to play on the hot topics of the moment, which are like global warming, save the earth, save the environment. So greenwashing is when a company takes their data and skews it to make it look like they're doing more for the environment than they are, or they take the environmental data that they have that's positive and use it to hide other negative aspects about their company. The firm alleges that Oatly has overstated both its revenue and margins to investors. Oatly denied these allegations, calling them false and misleading. And the company is only being shorted about 1% right now. So this is something that Spruce Point seems to be kind of alone on. Here's their website. They have an absolutely terrible graphic atop the report. I think I could have done better in Photoshop, and I don't even have Photoshop, so this is pretty awful. The data that they're sharing is kind of damning, and Spruce Point is talking about how Oatly is reporting different revenue figures in Europe and America. There's a discrepancy there. That's kind of undeniable, so either the company screwed up or they're trying to hide something. Also, they talk about how some of the executives had some rather shady practices with companies that had financial difficulties before, how the company has cycled through a bunch of different auditors in the last 3 years. That's never a good look. Why are the auditors leaving? Is the company hiding stuff? It doesn't really look so good. So take it or leave it, but this affected Oatly's share price a bit this week, and Oatly's share price has already been dropping since the run-up after IPO. Here's the daily chart. Remember, Oatly hasn't been trading for that long. It IPO'd at the end of May. On IPO, we closed at about $20.20. We went as high by the middle of June as $29, and currently we're down below IPO price, aftermarket at $19.30. The short report was released right here around the 14th, so this ended up causing a pretty substantial drop in share price, about 12% all in all since the short report was released. So the company does have a couple of things to answer for. This one doesn't seem as bad as some of the other short reports that I've read, and I think Spruce Point does have some very valid points here. But as with all shorters, remember, Spruce Point takes a short position, releases the report, drives down the share price, so they're obviously profiting from this, and they do label themselves as active investors, trying to expose fraudulent activity. So either way, it'll be interesting to see how this plays out. Oatly is now just sitting slightly below its IPO price. Not a big deal. Next news story is not really a news story, but it's kind of just something that I wanted to share and talk about a little bit. There's this Redditor, DarthTrader357, and just yesterday, he ended up posting this on Our Investing, strategies for investing in green energy and renewables. And without reading his whole post, I want to talk to you about the premise because it is very interesting. He talks about how if you want to invest in renewables, the best way to do it isn't actually to invest in a renewable company. Instead, it's just to invest in oil companies. His argument was that oil companies have money out the butt right now for R&D, and they're not ignorant. They know what's happening with oil as far as perception and PR, and they do eventually want to switch to green energy. Big oil has massive power, political power, financial power, huge treasuries, cash flows. Collectively, the big oil industry has more money to piss away on research than the entire value of the renewable sector. And he mentions that big oil's market cap is around $4 trillion. Renewable energy's market cap is around $95 billion. So yeah, I mean, we're looking at something that's like 1/40th the size. Big oil will wait until the margin is closer, then invest in renewables, use their political power to shut out anybody else, use their massive treasuries to shut out anyone else, use their propaganda machines, and wait to reduce the value of renewables and buy and absorb those companies into them when the price is right. And you know, in short, I completely agree with this entire thesis. We see this happening right now with EVs. You know, companies like Lucid, like Workhorse, like Ride, like Canoe, they're big. People talk about them. They get excited about them. But really, who's leading the market right now for electric vehicle sales? Tesla, GM, Ford for American companies, and then other big companies like Hyundai, Kia, Toyota, they're all leading the EV market. And the fact is, it's tough for these small players to break into the market when the big boys have budgets that are hundreds of times larger, thousands of times larger. The same premise can really be applied to oil. And we know that these oil companies have insane cash flow. Oil is projected to go up to $100 a barrel by wintertime. These companies are flush with cash. The big oil companies have a manageable amount of debt, and they can just do what they want with renewables and eventually bully the smaller companies out. So if you invest in a smaller renewable company, really what you might be doing is just investing for the hope of a buyout for one of these big dirty oil companies to come in and buy your clean green company. So this is a really interesting thesis. And if you look at the prices right now for companies like Chevron or Exxon, the valuations are pretty attractive. Exxon has a ton of debt. Chevron's in a better cash flow position. I'm thinking about Chevron. You know, this is another mature company fitting with the theme of the episode today, but I'm thinking about Chevron as a green energy play in the future. More news out of China. China is going to be cutting its 2021 steel exports under its green shift. We talked about this a little bit last week, how China is becoming a net importer instead of a net exporter. The reason that China is giving for this is that they're saying they're trying to shift their economy to meet green energy goals, to meet carbon credit goals, to meet emissions goals. Last week, I talked about the Alcoa aluminum earnings report. The earnings report was absolutely magnificent. It was even better than expected. And I want to go straight into the earnings transcript before looking at the numbers because the CEO said some really interesting stuff about China in the transcript. He said, "We continue to see China moving to constrain supply growth in energy-intensive industries like aluminum to help meet its own goals to reduce carbon emissions." So this kind of meets the theme of what we just saw in the last steel article, but still, that also means China's keeping its own stuff internal. And China is expected to remain a net importer of primary aluminum. So there we go. China is going to be a net importer of steel, a net importer of aluminum for the foreseeable future, and this is a really big deal because previously they were net exporters in both. As far as the earnings go, Alcoa sets the record for the highest quarterly net income and EPS, highest profitability since its 2016 inception with record quarterly net income of $309 million and an EPS of $1.63. EBITDA increased 19%, 60% year-on-year pricing increase for aluminum, used cash to strengthen the balance sheet, reduce debt, improve their global pension plan, which means happier workers. So all around, this was an incredible earnings report. The global market, as they discussed, is going to be even better for Alcoa going into the future. So how did the stock price react to this? Miserable, absolutely miserable. The day before the earnings, we closed at 35. The day of the earnings, we closed at 34.50. And then by Friday, we closed at under $33. My sadness is immeasurable and I am crushed. I put a lot into the options here and I'm still holding them because I think this is a net positive. The RSI just hit oversold again, so I don't see how it can go any lower. And I do expect a rebound this week in the stock market. That being said, this was deflating. You know, there were macroeconomic factors that could not have possibly been factored into the option prices and share prices at the time when I purchased the options. So this was a stunner. This was not something that I was expecting, and the earnings report was even better than I thought it would be. The macroeconomic indicators out of China are even better than I thought they would be, so I'm floored. I'm shocked, and this is not something I was expecting. Let's take a look at the upcoming earnings for this week. We've got a lot. We have a lot of the smaller banks going this week that didn't end up going last week with the big boys. I mean, this is just too much to cover here on this chart. We have IBM and Intel reporting. We've got my Cleveland Cliffs reporting Thursday before open. Super excited for that one. Coca-Cola coming in after Pepsi last week. Pepsi said the restaurant reopenings helped them a lot. Obviously, that's going to help Coca-Cola too. I always love seeing Chipotle's earnings report because they always talk about their huge growth as a company. Interactive Brokers is an interesting one. I want to see their user base growth. I've been hearing a lot of good things about Interactive Brokers as a trading platform. Del Taco should be reporting some positivity towards the end of their earnings report. Their forecasting for the future should be okay with a lot of the Western states opening up and lifting COVID restrictions. So that's good for Del Taco. But a couple of companies I want to look a little more closely at: Philip Morris International and Sands, Las Vegas Sands Corporation. Earlier in this video, we talked about how Chuck Schumer is pushing for federal legalization of marijuana. I believe that once marijuana gets legalized at a federal level, Philip Morris is going to be buying out a marijuana company in the United States, or at least buying a controlling stake in a marijuana company. This is because Philip Morris has not yet committed to moving into the marijuana industry. Instead, they've been focusing on their smokeless cigarette system, and there's been some whisperings with Philip Morris to where they're worried that they might be getting left behind with the trends on vaping and the trends on marijuana. And I strongly believe Philip Morris, here within the next year, if marijuana gets legalized, is going to end up acquiring one of these smaller marijuana companies. This is just from the end of April. Marlboro maker Philip Morris keeps cannabis options open. Their CEO said, "We're doing all this work and we'll determine one day what avenues to pursue, but our priority is what we're doing with our smoke-free products, and that's where I would stay on cannabis." The comments hint at a possible shift for a company that's kept to the sidelines of the marijuana market, even as other cigarette companies have jumped in. So this is one where I'm not necessarily expecting anything on the earnings report this week, but this is another mature company that I expect to be making pretty big moves into the marijuana market in the future. I'm not looking to add Philip Morris into my portfolio yet, but this is another one that I actually will consider opening a position with. One of the reasons for that is that Philip Morris is a steady dividend stock. It's one of those dividend kings in the market that tends to increase its dividend regularly. Right now, the dividend for Philip Morris is at 4.83%, which is quite high. Earlier in the video, we talked about Pepsi. Pepsi's dividend is sitting here at 2.77%. We've got Citigroup. Citigroup's dividend is 2.98%. So when you're looking at these mature companies, you're not going to get the outright share growth, but you are going to get some stability in the dividend. Now, I know I'm a little young to be a dividend investor, and that's not really the point, but the point is that for all three of these, I do see catalysts coming into the future here, or I do see improvements in the companies themselves, and the dividend just kind of offsets the slow growth of these companies and makes it worthwhile. The last company I want to look at that I actually think has a pretty strong play, not necessarily as an options play, because frankly, I don't have any money right now to throw at options, but I am considering opening up a commons position on Las Vegas Sands, which is reporting their earnings this week. Las Vegas Sands is a casino and resort company. They operate out of Macau, Singapore, and obviously Las Vegas. The company's stock has been in a pretty sharp decline, peaking at the end of April around $61. We're down here at $47.82, which is not far from its COVID drop at this point. The IV is a little bit high for me to want to play options. We're sitting here about 33% above the historical volatility, but compared to the IV highs just in the last year, this isn't super high. This is more like just a little bit of an earnings high. So if you do want to play options, I'm not going to, but at least it's not some crazy high IV, but it is increased a bit because of earnings. The put to call ratio is positive here, 0.22, which means there's more puts on the company than calls. The put to call ratio is a really interesting one because this is one indicator that a stock could become oversold. Typically, you want your put to call ratio to be around 0 because that's going to allow for organic growth with the company. But a put to call ratio of 0.2 means there are more people buying puts on on this company and there's more artificial downward pressure at the moment. And if we look at the chart right now for Las Vegas Sands, we can actually see that. A couple months back in March, we had a high of 66.77. And since then, we have dropped off all the way down to 47.73. For some perspective on the COVID drop, we went down to 33.30. So right now, at our current price, we're only sitting about 50% above the low point on the COVID drop. And this is with travel returning to normal slowly. So this is providing a really good entry point. And here on the RSI, we can see the RSI is hitting oversold on both the 6-day and the 14-day. MACD is also incredibly low right now. If you look at the financials for Las Vegas Sands, they're not great, but they're improving. Look at the revenue line. 1.2 last quarter, 1.5, 586, 98 going back into COVID. But if we go back to before COVID, we were at 3.5 billion. So this company still has its properties. The resorts are still there. All they need is customers. Plus, summer season is really busy. Why then has the price dropped off this sharply in this short amount of time? There was a report released on Benzinga about how gamblers are slow to return to Macau and how Singapore still has a lot of COVID restrictions in place. These are two of the three places where Las Vegas Sands operates its businesses. But one thing we know is that Americans are bucking the trend of staying at home and they're more keen to start traveling. Even if the Macau and the Singapore locations are slow to return to normal, I'm expecting Las Vegas Sands to give some type of positive indication or forecast for this summer in the actual Las Vegas, Nevada, USA locations of their casinos. This is just kind of a fun one, but it gives you the perceptions of Americans. Obviously, this isn't a serious source, but there was a survey that this organization conducted. 25% of Americans are planning on revenge traveling. Revenge traveling is where Americans want to travel more now that lockdown has ended to make up for the time that they miss. International travel is really difficult right now because of so many different COVID restrictions in different countries. So that means domestic travel is going to be increasing in America. Here on AAA, for the road trip destinations, Las Vegas was first, followed by Orlando. For airlines, Orlando is first, followed by Vegas. So you can see what I'm getting at here. Vegas is obviously a very attractive destination, and Americans don't care and they want to travel. I wanted to verify this with a slightly more reputable source, so I went to the Las Vegas Convention and Visitors Authority, which is like the statistical authority on everything Vegas travel related and tourism related. On this chart, everything is still red compared to pre-COVID benchmarks, but it's improving. The visitor volume, look just for this year from January to May, -62, -52, -40, -27, -22, and it's going to be improving more. We can see this trend line. There's more auto traffic going into Vegas right now than even before the pandemic, which is helping make up for the fact that people are not flying in as much. So we've got AAA reporting more travel. We've got some random travel website saying on a survey Americans are revenge traveling. And now we have the Las Vegas Tourism Authority saying that things are improving and we're getting really close to pre-pandemic levels. What am I thinking here? I'm thinking Las Vegas Sands is due for a little bit of a rebound, and I'm thinking we've kind of hit the bottom of this slump. With the RSI hitting oversold, with the put ratio as high as it is, with probably what's going to be a positive earnings report for the American aspect of the company this week. So I'm thinking Las Vegas Sands is going to be doing pretty well here. Now, with all of the companies that I've been talking about this week, the mature companies, Pepsico, Citigroup, Philip Morris International, Las Vegas Sands, I'm actually thinking of opening up a commons position in Las Vegas Sands here at the beginning of the week and just kind of hanging on to these shares. The other thing to remember is the holiday seasons. Right now, it's summer travel holiday time for Las Vegas. This is when they get most of their revenue coming into the hotels and casinos. But for Macau and Singapore, their big travel time isn't necessarily in the summer, but it's actually in January with the Chinese lunar holiday. So that's when they get a lot of their travel, their business, their gambling. So as long as COVID restrictions are lifted by January, February, Las Vegas Sands might be reporting some pretty good earnings surprises throughout this coming year. That's it for me today, everybody. I hope you did enjoy the video. As always, if you want to support the channel, please check out my Webull referral link below the video. If you sign up for an account, deposit $100, you get a free stock, I get a free stock, everybody wins. Also, if you enjoyed the video today, please be sure to like the video. Subscribe to the channel if you want to be alerted to all my YouTube content as soon as it goes live. Make sure you hit that notification bell. All right, everybody, thanks a lot. Stay safe. I hope this week treats you better than last week. Good luck, and I'll see you next time.